What is going on with interest rates today? Man, woke up today, kind of had a bad opening. The bond market was showing the mortgage-backed securities were down about 30 basis points, and they quickly jumped up to being down 86 basis points, which again, when I say down, that means interest rates are going up. So it's an inverse effect. Look back at some of the other videos if you want to see more on that kind of charting, but 86 basis points down is definitely going to cause an interest rate adjustment, probably an eighth to a quarter% in interest rates. So why does something like that happen? Where last night I go to bed, I see rates are pretty steady. They've been steady for the last week. All of a sudden, interest rates just take a big hit. Why is that? Well, today, it is because we all know that we're worried about inflation. We're fighting inflation. That's why the Federal Reserve is increasing their federal funds rate to try to slow the market down. And they're trying to raise rates all around because that slows the overall economy. Unfortunately, that's painful to a lot of people. So causing home loan interest rates and borrowing interest rates to go up. So what happened? Well, one of the Federal Reserve governors, whose last name is Brainard, so actually their last name is Brainard, made some comments this morning during an interview that were very aggressive towards monetary policy tightening, which means he was basically, or she was basically saying, hey, inflation's out of control. We got to do something, and we got to do something quickly. We got to respond more quickly, which would make you say, okay, well, the next time the Federal Reserve meets, which is about every 6 weeks, they're going to raise interest rates 1/4% instead of an eighth. Well, maybe they're going to raise interest rates 0.5% instead of an eighth. That may be what she was kind of pointing to. Now, again, that's the federal funds rate, not necessarily home loan interest rates, but the federal funds rate is directly tied to the prime rate, which is directly tied to credit cards and home equity lines of credit in most cases. So you're going to see an increase in some of the borrowing costs if the federal funds rate is increased by the Federal Reserve. But again, the Federal Reserve does not directly control home loan or mortgage interest rates. They can't go in and pull a lever and say interest rates are now 6% instead of 5%. They don't have that control specifically on mortgage-backed security interest rates or the standard mortgage interest rate. So what's worse, though, is that the Federal Reserve or Governor Brainard also said that they want to drastically reduce their balance sheet. Okay, so what does that mean? That is actually more concerning to the home loan interest rate market than saying we're going to increase the federal funds rate. And why is that? Because what the Federal Reserve also does is they manage the supply and demand of mortgage-backed securities. So the value or the demand for mortgage-backed securities at what interest rate is what determines the interest rates that we pay on home loans. I know that's a mouthful and there's a lot to it, but basically what it means is, let's take something simple. So let's say that there's 100 candy bars on the counter, but only 10 people like that flavor of candy bar. Okay, so you're not going to be able to sell that candy bar for a very high price if there's just a whole bunch of extras laying around, supply and demand. So what the Federal Reserve does is they come in and they buy like 8 of those candy bars and they put it on their balance sheet. Okay, that's what they call their balance sheet, which then makes those 2 remaining candy bars pretty valuable, right? Because 4 or 10 or 8 people want those candy bars. So they can increase the price of those candy bars. So I'm simplifying something, but basically what they can do is they can absorb excess mortgage-backed security bonds in order to make them feel scarce to the rest of the investing community, those that want to invest in mortgage-backed securities. So that's how they control the cost of mortgage-backed securities, is through their balance sheet, which means they absorb part of it. So they've been doing that for like a decade. I mean, they've been doing it for a very long time. So for instance, if we sell $200 million in home loans and Fannie Mae and Freddie Mac now have all these mortgage-backed securities that they need to sell, well, they put it on the market, they find out what kind of demand is out there for those mortgage-backed security bonds, and then the Federal Reserve comes in and says, well, let me buy half of those. Let me take half of those off your hands. That creates liquidity that puts money back in the hands of Fannie Mae and Freddie Mac, which creates liquidity for them to continue to turn mortgages over, continue to fund mortgages, and it also controls the cost that people are willing to pay for a mortgage-backed security with a specific interest rate tied to it. Let's say 2.5%, 3%, 3.5%. If nobody wants to buy a 2.5% interest rate bond and they just sit on the shelf, what do? Well, give them a 3% interest rate return. Give them a 4% interest rate return. Now that investor goes, ooh, I'll take 3.5% return, right? And now they buy it. So again, simplifying a very confusing topic. But the Fed Governor Brainard said they want to reduce their balance sheet. Okay, so there's a couple different things that this actually indicates. There is someone who says, hey, we need to stop growing our balance sheet. That means we're not going to absorb any more of the mortgage bonds that are being put on the market. Okay, that's bad. We don't want that. From the home loan world, we don't want that. But what's worse is when they say, not only do we want to stop buying mortgage-backed securities, we want to reduce the amount of mortgage-backed securities that we have. We're going to sell what we have in our inventory. We're going to start putting that on the market. So again, if there was $200 million in mortgage-backed securities for sale, well, now the Federal Reserve is going, we want to offload another 50 million ourselves. So now there's 250 million. We've upped it by 50 million. Again, these are examples, but that then shows that there's more on the market. There's more on the shelf, which means that there hopefully are enough buyers to buy those mortgage-backed securities. Otherwise, we're going to have to entice more buyers by giving them a better price or a better rate. So what that essentially means is if the Federal Reserve is going to sell mortgage-backed securities that they own on their balance sheet, and they're not going to buy any of the new ones that are being created through the mortgages that are happening day to day, it is going to create inventory, loose inventory of mortgage-backed securities, which means we need to attract a lot of buyers outside of the Federal Reserve. And the way that you traditionally do that is by offering a higher rate of return, which is a higher interest rate. Okay, so again, oversimplifying a much more complicated situation, but there are two factors here. They're talking about raising the federal funds rate, which influences mortgage interest rates, and they're talking about reducing their balance sheet, which means stopping the buying and adding the selling. Two things that we don't want. Well, the overall market heard that the same way that I did, and interest rates have gone up throughout the day today. So we're seeing another tick up in interest rates. For instance, if you were 4.5 yesterday, you're probably 4.75 today. That's a good example. If you were 5.25 yesterday, you're probably 5.5, 5.625, somewhere in that range. So we've seen another jump up. Now, hopefully, sometimes what happens is markets have what's called knee-jerk reactions. They move very quickly to news, and then they digest it for a while. They think about it for a while, and they start to kind of settle, and the adjustments will kind of come back in place, but not as much as, so it's not going to all go away. So the pain that we felt this morning isn't going to all go away as everyone settles down and calms down, but hopefully some of it will go away, and maybe not having a 0.25% interest rate, but more of like 1/8% interest rate by the time that today is over. So big day. I went over a lot of information, but this is the kind of thing that we're watching day to day. And when you start to hear things that are happening, whether it's CNBC or ABC in the news or anything having to do with Squawk Box or anybody else, you can start to learn by following this channel. Make sure you subscribe, like, share, whatever you need to do. And we will continue to learn more about what causes the interest rate fluctuations. And you will be able to speak more to the people that you're working with, or even for yourself. If you're just a home buyer, if you're not even in the real estate world, at least you'll understand a little bit more about what causes interest rates to fluctuate. All right. Thanks a lot. Let me know what questions you have. Give me some comments below. If you don't agree with my comments, let me know. Hey, we'll talk about it, and have a great day.